12 assets can change a veteran's financial life. Most are not exotic investments. They are benefits, accounts, skills, legal rights, and pieces of property that either produce income, reduce a permanent expense, or protect money you already earned. That is my definition of an asset today. If it pays you, grows for you, saves you a recurring bill, or increases what your work is worth, it belongs on the list. And no, every veteran will not have all 12. The point is to see which ones are sitting unused in your own life. Asset number 1 is a cash reserve. Cash does not make you rich through a spectacular return. It keeps an emergency from forcing you into expensive debt or a badly timed sale. Keep the reserve somewhere safe and accessible, such as an insured high-yield savings account or an appropriate money market deposit account. Do not chase an extra fraction of interest with money you may need next Tuesday. For a household living on VA compensation, retirement pay, or Social Security, start with 1 month of essential expenses, then work toward 3 to 6 months. The exact target depends on income stability, health, vehicles, and the home. Asset number 2 is the Thrift Savings Plan. If you still have access through federal or uniform service, the TSP offers low-cost diversified funds and tax-advantaged growth. Under the blended retirement system, eligible service members can receive government contributions, but the matching rules and vesting details matter. The first move is not picking the cleverest fund. It is confirming that contributions, beneficiary designations, contact information, and investment allocation are correct. An old address or forgotten beneficiary can create more damage than a mediocre month in the market. There is a difference between owning an account and having a plan for it. A veteran can leave service with 5 small accounts, no idea what each one holds, and 4 different beneficiary forms. Build one inventory. Record the institution, account type, balance, investment, fee, beneficiary, and the person to call. Do not include passwords on a sheet left in a drawer. The goal is for a spouse or trusted person to know the accounts exist without creating a security risk. Then check concentration. If nearly everything is tied to one employer, one company stock, one property, or one speculative asset, the household may look wealthy and still be fragile. Diversification is not exciting. That is exactly why it works as a foundation. Asset number 3 is an IRA, or employer retirement account. The account is a container, not an investment by itself. Inside it, many veterans use broad, diversified funds rather than trying to predict the next winner. Traditional contributions may reduce taxable income today. Roth money can create tax-free qualified withdrawals later. Which one fits depends on today's tax bracket and the bracket you expect in retirement. Do not move an old TSP or 401k because a salesperson says consolidation is always cleaner. Compare investment costs, withdrawal options, creditor protection, access rules, and the services you actually need. A rollover can be sensible. It can also move low-cost retirement money into a more expensive product. The asset is not the logo on the statement. It is the after-fee income the account can support. Dear friends, you no longer need to watch 1,000 videos trying to find benefits that match your life. At AbundantYears.com, we organize a personal list of 18 to 28 benefits based on your state, age, and situation. You can also get free checklists and request a private one-on-one conversation. We have gathered the starting points in one place. Visit AbundantYears.com or use the link in the description. Asset number 4 is the VA Home Loan Benefit. The value is not a free house. It is access to a mortgage program that may allow no down payment, competitive terms, and no monthly private mortgage insurance. There is still underwriting. The borrower must afford the payment. Taxes, insurance, maintenance, and the funding fee may still apply, although some borrowers are exempt from the funding fee. Use the benefit to buy a home that fits the household budget, not the maximum amount a lender approves. Equity becomes an asset when the payment is sustainable and the property is maintained. Asset number 5 is home equity that lowers future housing cost. Paying extra toward a low-rate mortgage is not always the best mathematical move. Paying off high-rate debt often comes first, but entering retirement with a manageable or eliminated housing payment can reduce how much income the portfolio must produce every month. The calculation is personal. Compare the guaranteed interest saved with the liquidity you give up. Never put every available dollar into the house and leave yourself borrowing on a credit card when the roof fails. Asset number 6 is the post-9/11 GI Bill. Used well, it converts service into tuition support, housing assistance, books, and a credential with labor market value. Used badly, it burns months of entitlement on an expensive program that does not improve earnings. Some veterans with more than one qualifying period of active duty may now qualify for additional combined entitlement under the Rudisill decision, potentially up to 48 months. That is an eligibility determination, not a universal bonus. Check the VA education record before assuming the old 36-month number is final. The other hidden value is transfer planning. Transfer of post-9/11 entitlement generally must be approved while the service member is still serving and can involve an additional service obligation. A veteran usually cannot wait until years after separation and newly transfer the benefit. Families approaching separation should treat that deadline like an asset decision, not an education decision for later. Compare approved schools through VA's GI Bill comparison tool. Check completion, cost, complaints, and whether the occupation actually hires in your region. One entitlement month is an asset. Treat it like one. Asset number 7 is Veteran Readiness and Employment, or VR&E. VR&E is not simply another GI Bill. For an eligible veteran with a service-connected disability and an employment handicap, it may support a plan leading to suitable employment or greater independence. That plan may involve education, training, accommodations, counseling, or job placement support. The key word is suitable. The goal is work you can prepare for, obtain, and maintain without ignoring the limitations created by service-connected conditions. VA says veterans can apply with at least a 10% service-connected rating, but a counselor determines entitlement and the rehabilitation plan. If the veteran has at least 1 day of post-9/11 GI Bill entitlement remaining and meets the eligibility period rules, the veteran may be able to elect the post-9/11 subsistence rate during VR&E, which is often higher. Ask the counselor. Do not assume the payment switches by itself. VR&E may also restore some previously used education entitlement through retroactive induction when the requirements are met. That is not available in every case, but it is important enough to ask about by name. Asset number 8 is a marketable skill, a commercial license, cybersecurity certification, nursing credentials, skilled trade, project management ability, or sales skill can produce income for decades. The best credential is not the one with the loudest advertisement. It is the one employers repeatedly request in real job postings. Before paying for training, collect 20 job listings. Count the required credentials. Call 2 employers, then choose the program. That 10-minute reality check protects months of benefits. Asset number 9 is VA disability compensation, when the evidence supports it. Compensation is tax-free under federal law and adjusts when Congress authorizes the annual cost of living increase. It is not an investment return. It is payment for the loss in earning capacity associated with service-connected disability. Its financial value can extend beyond the monthly deposit. A rating may affect health care priority, funding fee exemptions, state benefits, property tax relief, or dependent education eligibility. Those connected benefits do not all activate automatically. This is why the rating decision belongs in the financial binder, not only the medical folder. Record the combined rating, effective date, permanent and total status if present, dependent status, and every connected benefit confirmed from an official source. A 100% rating and a 100% permanent and total designation can open different doors. Read the words, not only the percentage. If a condition genuinely worsens, review the evidence before filing an increase. Filing is not a wealth strategy by itself. The claim must reflect the veteran's actual disability, and opening a claim can lead VA to examine the condition. Use an accredited representative and decide from evidence rather than from a promise made in an advertisement. Asset number 10 is VA healthcare and prescription coverage. Health coverage becomes a financial asset by removing or reducing a cost that can destroy a retirement plan. Eligibility and priority groups differ. Some veterans combine VA care with Medicare or employer coverage. The correct arrangement depends on where care is available, which doctors you use, and how emergency and community care rules apply. Do not drop other coverage because somebody online said VA pays for everything everywhere. Map routine care, specialists, prescriptions, urgent care, emergency care, dental care, and travel before changing insurance. Asset number 11 is state and local veteran tax relief. Depending on the state, disability rating, residency, income, wartime service, and home ownership, a veteran may qualify for property tax relief, vehicle benefits, military retirement exclusions, or other tax preferences. These programs can be worth more than a small investment return because they remove a bill every year, but they are not administered by VA. The county or state usually requires a separate application and a current VA benefit letter. Asset number 12 is ownership. That can mean a diversified stock fund, rental property that truly cash flows after repairs, or a small business with repeat customers and clean books. For veterans, federal and state contracting programs may create opportunities for verified veteran-owned or service-disabled veteran-owned businesses. Certification is not a contract. The business still needs a product, pricing, past performance, and the ability to deliver. Ownership is last because it works best after the foundation is stable, cash first, expensive debt under control, insurance and health risks understood. Then money can stay invested long enough to work. For a small business, separate revenue from an asset. A self-employed veteran who must personally work 60 hours for every dollar has created income, but not yet a transferable business. The business becomes an asset when records are clean, customers return, work can be delivered consistently, and the operation is not trapped entirely inside one person's head. Veteran-owned and service-disabled veteran-owned certification can help a qualified company compete for certain contracts. Certification does not create demand. Before paying for a website, capability statement, or bid service, identify actual agencies and prime contractors buying what the company sells. Ownership creates wealth when the customer is real and the margins survive delivery. Here is the 12-asset audit. Circle every asset you already have. Put a dollar value beside it. For a benefit, use the annual payment or annual expense saved. For education, estimate the realistic increase in earnings, not the school's advertising claim. For property, subtract debt and expected repair costs. For an account, write the actual balance and fees. Then mark one asset as unprotected. Maybe the TSP has no current beneficiary. Maybe the home lacks an emergency reserve. Maybe the VA rating opened a state tax benefit nobody filed for. Finally, mark one asset as unused. That may be remaining GI Bill entitlement, VR&E eligibility, a property tax application, or a skill that needs one credential to become marketable. Wealth is not 12 logos on a screen. It is a household with several independent supports. Income still arrives when work stops. Housing remains affordable. Medical bills do not consume the reserve. Skills can create new earnings. Investments have time to recover. Survivors know what exists and where the documents are. You do not need all 12. You need the right combination, documented, protected, and actually used.